problem with silver is rather like the problem in the oil market. There's going to be a crisis in silver which could push the price considerably higher. Now, of course, we never know when these things actually kick off. Basically, you're either going to be in it or out of it. You can see that silver actually shouldn't be at this level at all. It should be considerably higher. America hasn't got a hope of building a strategic stockpile unless it goes into the market and aggressively bids, which I guess it wouldn't do because it would just drive the price through the roof. Silver, I think, is mispriced. It's purely an industrial metal. I know that we push it around on the basis that gold's going up, therefore silver goes up, gold goes down, therefore silver goes down, at roughly twice the pace. There is going to be, I think, an enormous bear squeeze on a paper market system which simply cannot handle it. I mean, here we have gold and silver considerably higher than they were over the course of last year. Yet open interest on COMEX is at the lowest levels we have seen in a very long time. I mean, we're talking decades now. Yeah, I think the problem with silver is rather like the problem in the oil market. We know that oil in Asia is changing hands at anything north of $150 a barrel, whereas on COMEX, I mean, it's sort of 90. Not doing anything. There's this sort of disconnection with reality, and the same is also true of silver. The interesting thing is that ever since silver peaked at about 120 at the very end of January, China has been buying it back in quantity. We have the first quarter's figures of their buying of silver, and it is really massive. I mean, some months we're seeing record levels of silver inflows into China. Now, this is a turnaround in China's policy because really until, well, certainly September last year, her policy was to supply silver to the rest of the world in an effort to try and dampen any upward price moves. And this has been a long-standing policy, but that suddenly changed. And it changed really in, I would say, September last year, when China also changed her policy on rare earths, on the export of rare earths. I mean, this was after one of President Trump's tantrums, if you like, tariff tantrums against China. So China actually went on the offensive and said, right, look, that's your attitude. You go and get your rare earths from somewhere else. What we didn't know at that time was that China was also doing the same thing with silver. And I think the reason for that is that the US Geographical Survey was recommending to the government, the US government, that they declare silver as a critical mineral. And indeed, the government took that advice up, and it is now, as far as the US is concerned, a critical mineral.
Markets keep pricing silver like a discretionary asset, while governments increasingly treat it like infrastructure. As Alasdair Macleod points out here, the overlooked signal is not price action, but policy reversal. China moved from supplying silver to accumulating it, while the US elevated silver into strategic territory. When states change behavior before narratives change, paper pricing becomes less informative. For long-term investors, the risk may not be volatility. It may be assuming availability remains permanent. Next, Alasdair Macleod exposes why strategic mineral status and public pricing cannot both remain true.
China was in the position of, having suppressed the price of silver. She now didn't want to supply the US, if you like, so that the US could just stockpile this new critical mineral. So she'd basically withdrew from the market. Now, we only discovered this, really, on October the 9th, when the lease rate in London shot up to around about 40%. And the reason for that is that people who had bought forward contracts in silver decided to take delivery rather than sell them out at a profit or loss. And it was really from that point that silver broke through the $50 barrier and subsequently ran up to $120. Well, we have a similar situation today. There is very, very little silver around. The stocks in COMEX have been diminishing. And as we know from China's customs figures, she has been importing fairly heavily. She has continued to export some silver, but not very much. And I guess that is to satisfy existing contracts rather than anything really new. So with China going on to the offensive, buying back in silver, I mean, this is now one of a number of things that China has been doing. If you look, for example, at iron ore, she's been stockpiling iron ore. If you look at copper and nickel ore, she's been stockpiling that. And also things like sulfur, urea. These were things that basically were exported in significant quantities out of the Persian Gulf. And now that that supply line is disrupted, China is taking the view, well, we've got to hang on to our own production rather than anyone else's. The interesting thing about sulfuric acid, which again is a major, major export from the Persian Gulf, China was the largest exporter of sulfuric acid.
A market only discovers scarcity when people stop settling in cash and start demanding delivery. According to Alasdair Macleod, the October lease rate spike mattered because it exposed behavior change beneath the headline prices. Institutions talk liquidity, yet strategic stockpiling across metals and input signals concern about future access, not near-term profit. If that interpretation is even partially correct, ordinary savers face replacement costs later rather than attractive entry prices today. Next, Alasdair Macleod reveals the hidden supply chain input that could tighten silver without investors noticing.
And now what she's decided to do is to stop exporting it completely. Why? Because sulfuric acid is a very important chemical in the refining of non-ferrous ores, particularly copper and also nickel and to a lesser extent lead. Now, if you look at where the silver comes from around the world, over 50% of it, I think 56, 57% of it comes from copper and nickel refining. So you can see that with the rest of the world deprived of quantities of sulfuric acid, there is a supply problem developing in certainly copper and also nickel. And if you look at the prices of those two base metals, yeah, they've been rising very, very strongly. So given that, copper's been hitting new highs. I mean, it's really performed extremely well since the Gulf situation kicked off. Silver hasn't. Silver's just moved sideways. This is crazy. Now, when you consider that the use of silver in industrial purposes is exactly the same as many of the uses of copper, in other words, electricity use, photovoltaic cells. You've also got electric vehicles and so on. You've also got defense applications and so on. I mean, the two things are basically used together, and silver is the metal which is short of what, there's a shortage of. It is also by far the most important conductor of electricity and also as a thermal conductor. So it doesn't make any sense that copper and also nickel, though that's a slightly different category, should be hitting new highs when silver is just languishing where it is.
Copper surged while silver stalled, and historically that divergence rarely stays unresolved forever. What Alasdair Macleod is highlighting is that investors may be watching the wrong commodity and missing the bottleneck underneath production itself. If over half of silver output rides on refining economics elsewhere, shortages can appear before silver charts react. Portfolio protection becomes difficult when pricing models assume smooth supply while industrial inputs quietly disappear. Next, Alasdair Macleod unravels why industrial demand assumptions may already be behind reality.
So the only thing I can conclude is rather like oil being mispriced in paper markets, when you see that physical deliveries are taking place at 50 to 60% premiums in Asia, I think the same is true of silver. So that's an interesting one. Now, it's not just a situation where, the refining of copper and nickel and so on and so forth being threatened, driving up the price of those commodities. Therefore, it should drive up the price of silver. Silver has been in supply deficit now for, 6-7 years. The use of silver since the Silver Institute's last report, which was a few months back, has actually increased quite significantly from when Metal Focus would have put together the figures and the estimates, if you like, for industrial use. They thought that industrial use of silver would decline slightly in 2026 compared with 2025, which again was a slight decline on 2024. Now, given AI, given huge great data centers being built everywhere, given the fact that armaments have got to be replaced because stocks in America, Europe, and Israel are just about run out, so that they really are having to accelerate the replacement of missiles and all the rest of it. You can see that silver actually shouldn't be at this level at all. It should be considerably higher. And of course, America hasn't got a hope of building a strategic stockpile unless it goes into the market and aggressively bids, which I guess it wouldn't do because it would just drive the price through the roof. So silver, I think, is mispriced. I think it's probably, it's purely an industrial metal. I know that we push it around on the basis that gold's going up, therefore silver goes up, gold goes down, therefore silver goes down at roughly twice the pace.
If supply deficits persist while demand forecasts stay conservative, the eventual adjustment rarely feels gradual. Alasdair Macleod's argument suggests investors may still be treating silver as leveraged gold, while industrial consumption keeps broadening underneath the surface. Data centers, electrification, and defense replacement cycles create demand that does not disappear because sentiment turns negative. For wealth preservation, the danger is not missing a rally. It is trusting models built for a slower world. Next, Alasdair Macleod reveals the contradiction between strategic demand and publicly accepted silver pricing.
But that's actually not the way it should be looked at. The way it should be looked at is this is purely an industrial metal with no premium in it whatsoever for, if you like, speculation about the purchasing power of the dollar, the way in which gold is valued, if you like. So that is something which I think is still ahead of us. I mean, you can imagine if the next run in gold, which I think has been brought forward by the war against Iran and brought forward considerably, what happens then is you're going to get a huge, great clash between the industrial demand and new investor demand, investors who feel that if you want to play the gold game, then go buy silver because it goes up twice as fast. And furthermore, you're only paying 75, 80 dollars an ounce as opposed to $4,500, $5,000 for gold. So there is going to be, I think, an enormous bear squeeze on a paper market system which simply cannot handle it. I mean, here we have gold and silver considerably higher than they were over the course of last year, yet open interest on COMEX is at the lowest levels we have seen in a very long time. I mean, we're talking decades now. When you see a price rise, you expect open interest to expand with a rising price. This is not what's happened. On a rising price, we have actually seen open interest in silver and gold fall. And now gold, for example, I mean, that's recently declined very, very sharply. And it's now roughly 327, 330 contracts, open interest. And I would have said before this that an oversold condition was somewhere around about 400,000 contracts. We're way below that. It's almost as if these paper markets are now irretrievably broken.
Markets rose, but participation fell, and in prior cycles that divergence rarely ended quietly. This is where Alasdair Macleod's thesis shifts. The signal is no longer price alone, but collapsing open interest during higher precious metal prices. That pattern suggests less speculative fuel and more constrained positioning beneath the surface. If industrial demand collides with renewed investment flows, portfolio exposure may become harder to build than expected. Next, Alasdair Macleod walks through the exact timeline when institutional money shifted from paper exposure to constrained physical markets.
So, coming back to silver, it really does look as if there's going to be a crisis in silver, which could push the price considerably higher. Now, of course, we never know when these things actually kick off. Basically, you're either going to be in it or out of it. And so, my view is that you should be in silver. Don't worry about the short term. Don't worry about it. And when it comes to gold, don't worry about gold either. The conditions are similar, though you don't have the industrial use. It's a pure monetary use. Really, what you're doing with gold is you're selling dollars. And selling dollars is the way to look at it. If you want to sell gold, then you're buying dollars. Do you really want to do that? I would suggest no.
Before we leave the topic of the precious metals, I wanted to point out a couple of rather interesting articles that came out in the middle of May from HSBC Bank and then UBS, who suddenly, and we should note that Tether, which is one of the biggest buyers of gold, and you'll tell us more about that, we are told actually hired on most of HSBC's gold traders about a year ago, and now they are coming out with, after they've been accumulating, and they're in the midst of an accumulation phase for gold, they're coming out with articles forecasting lower prices year over year for gold, and then UBS the same. It smells a little bit like a bash and stash operation, but maybe you can tell us what you're seeing about that, the stablecoin industry gobbling up gold physically, hiring buyers from the banks, and then coming out with lower forecasts.
Yeah.
Nobody notices institutional conviction until the public forecast suddenly points the other direction. As Alasdair Macleod points out here, the more interesting question is not whether lower forecasts are right, but whether positioning changed before the narrative did. When accumulation and public caution appear together, investors should pay attention without assuming intent. For people protecting wealth, the danger is outsourcing conviction to institutions whose incentives are invisible. Next, Alasdair Macleod exposes the one positioning signal that matters more than analyst price targets.
That's interesting. I didn't see that. Perhaps I wasn't paying attention. But it's absolutely crazy to come out with forecasts like that. Simply because I think these people don't understand what's going on. It's a falling dollar, not a rising gold. Now, effectively what they're saying is they think the dollar's going to go up. I would be very interested to know the basis on which they would say that. So let's dismiss that. I think the Tether thing has actually been very, very interesting because if you want to issue a currency as a gold substitute, one way in which you could do it is to do it as a stable coin. And it seems to me that the people at Tether have taken the view that the normal, the risks, if you like, at the moment appear to be to the normal stable coin industry, which could be from a legislative point of view. It could be, I suppose, from the recent acts in America, legislation in America would suggest the opposite. But I would say that Tether must have taken the view that there is a risk to the dollar's purchasing power. There is a risk, if you like, to the fiat currency system. And so their insurance policy, if they want to continue in business, is to set up a gold substitute, because if the fiat currency system is on its last legs, then obviously you've got to look at the alternative. And the alternative is quite simple, it's gold. So someone, I think, quite smart has actually looked at how a gold substitute works, how a gold standard works. So they could use that, I think, quite sensibly. So I think that's why they've been accumulating gold. I don't know the people at Tether at all, but I mean, it smells to me that that's actually what they've been doing. And I think that is an extremely interesting and innovative approach, if you like, to the end of the fiat currency system.
The public story says confidence in fiat remains intact, yet alternative settlement systems keep expanding. According to Alasdair Macleod, framing gold as a currency substitute changes the debate entirely, because it stops being a commodity call and becomes a trust calculation. That does not mean collapse is imminent, but it does raise questions when private actors build monetary hedges while public messaging stays calm. Savers should watch incentives, not headlines.